They tell you the banking system is safe, regulated, protected, that your money sits in a vault somewhere waiting for you. That story falls apart the moment you ask where your deposit actually goes the second you hand it over. Because here's the uncomfortable truth. When you deposit money in a bank, it stops being yours in any meaningful sense. You become a creditor. The bank becomes a borrower, and the difference matters more than anyone admits. Right now, the global banking system holds over $180 trillion in assets. That sounds stable until you realize most of it doesn't exist as cash. It exists as promises. Loans built on deposits, built on confidence, built on the belief that not everyone will want their money at once. So the real question isn't whether banks are safe. It's what happens when that belief cracks. And the answer is not as protective as we're told. This matters now because we're watching it happen in real time. Banks fail. Deposits disappear. Governments step in. And every time the same question surfaces, who actually owned that money? The person who deposited it? The bank that lent it? The borrower who spent it? Or the system that decided who gets paid back first? What banking actually is. Let's start with what you think happens. You deposit $10,000. The bank keeps it safe. You can withdraw at any time. Simple, right? Except that's not how it works. Not even close. The moment your money arrives, the bank doesn't store it. It lends it. Not all of it, but most of it. This is called fractional reserve banking. The bank keeps maybe 10% in reserve and loans out the rest. So your $10,000 becomes $1,000 in the vault and $9,000 lent to someone buying a house. That person's $9,000 goes to the seller. The seller deposits it in another bank. That bank keeps $900 and lends out $8,100. The cycle continues. Your original $10,000 has now created $50,000 or more in the economy. This is how money multiplies. This is also how it disappears. Because the catch, all those banks promised all those depositors they could have their money back anytime, but the actual cash doesn't exist. It's been lent, borrowed, spent, and lent again. The system only works if most people leave their money alone most of the time. That's not a safety feature. That's a vulnerability pretending to be a system. Banks don't fail because they're robbed. They fail because too many people ask for their money back at once. When that happens, the bank doesn't have it. Not because they were careless, but because the design of banking requires them not to have it. This is called a bank run. And it's not a bug. It's a feature of how fractional reserve banking has always worked. The illusion of safety. Now, governments know this is fragile, so they built protections. Deposit insurance. Central bank backstops. Regulatory oversight. In the US, the FDIC insures deposits up to $250,000. In Europe, it's 100,000 euros. These systems exist to prevent panic. They tell depositors, don't worry. Even if the bank fails, you're covered. But here's what they don't emphasize. Insurance funds are tiny compared to total deposits. The FDIC has about $125 billion to cover $10 trillion in insured deposits. That's roughly 1.25%. So if multiple large banks fail simultaneously, the insurance fund doesn't cover the losses. The government steps in, which means taxpayers step in, which means you're not protected by insurance. You're protected by the political willingness to bail out the system. And that willingness is not guaranteed. It's a choice made in crisis by people under pressure. Sometimes they save everyone. Sometimes they don't. In Cyprus in 2013, depositors with over 100,000 euros lost money. In Iceland in 2008, foreign depositors lost everything. The pattern is clear. When the system breaks, the rules change. Safety is not a right. It's a decision someone else makes about your money. This is why the phrase too big to fail exists. It's not about the bank. It's about the deposits. Because if a major bank collapses, it's not just shareholders who lose. It's millions of depositors who thought their money was safe. And governments know that panic spreads. One bank run triggers another. Confidence evaporates. The entire system seizes. So they intervene. Not to protect you specifically, but to protect the system you're part of. The hierarchy of claims. Here's where it gets darker. When a bank fails, there's a legal order for who gets paid. It's called the creditor hierarchy. And depositors are not at the top. First come secured creditors, people who lent money with collateral. Then come unsecured creditors, bondholders who lent money without collateral. Then, and only then, come depositors. But even among depositors, there's a pecking order. Insured deposits under the guarantee limit get paid first. Uninsured deposits, anything over that limit, get paid from whatever's left. Shareholders get wiped out. And if there's nothing left, uninsured depositors lose money. This isn't theoretical. It happened in 2023 when Silicon Valley Bank collapsed. Depositors with balances over $250,000 had to wait to see how much they'd recover. So the money you think is yours isn't really yours. It's a claim, a position in line. And where you stand in that line depends on how much you deposited and what kind of account you have. Most people never think about this because most of the time it doesn't matter. But when it matters completely. And here's the part that makes people uncomfortable. Governments have legal mechanisms to prioritize stability over individual depositors. It's called bail-in legislation. Instead of taxpayers bailing out failed banks, the bank's creditors, including depositors, take the loss. Your deposit gets converted into bank equity. You become a shareholder in a failing institution. This has already happened in Europe. It's legal in many countries, and most depositors have no idea it's even possible. So who controls money when the banking system is under stress? Not you. Not the bank. Not even the government in the way you'd think. Control belongs to a triangle. Central banks decide how much liquidity to inject. Regulators decide which banks to save. And markets decide how much confidence to withdraw. Everyone claims authority. No one has full command. Central banks can print money to stabilize the system. But printing has consequences. Inflation. Currency devaluation. Wealth transfer from savers to borrowers, so the central bank isn't saving your money. It's choosing which kind of crisis to have. A banking crisis or a currency crisis. Both hurt. One is just slower. Regulators can seize failing banks, merge them, or shut them down. But they do this based on systemic risk, not individual fairness. If your bank is small, it fails cleanly. Depositors lose money. If your bank is massive, it gets rescued. Not because you deserve protection, but because the system can't handle the fallout. The size of the bank determines the size of your safety net. That's not regulation. That's triage. And markets, they don't vote. They react. When confidence drops, money moves. Not tomorrow. Today. Investors pull deposits. Stocks crash. Credit freezes. And governments respond by doing whatever prevents total collapse. Rule of law becomes flexible. Ownership becomes negotiable. And the people who move their money first are the ones who keep it. This creates a strange dynamic. The system is designed to protect stability, not savings. So when things break, the priority is keeping the machine running, not making sure every individual gets made whole. And because most people don't understand this, they keep trusting institutions that are not actually designed to protect them specifically. The uncomfortable math. Let's get precise about the risk. Total global deposits are around $120 trillion. Total capital in the banking system, the actual cushion that absorbs losses, is maybe 8 to 10%. So if losses hit 10% across the system, banks are insolvent. Deposits exceed assets. The money is just gone. Now, that sounds extreme. And it is. But it's not impossible. In 2008, some banks lost 40% of their value in months. Real estate crashed. Mortgages defaulted. Assets that were rated AAA became worthless. And the only thing that stopped total collapse was governments stepping in with trillions in guarantees, loans, and freshly printed money. But that intervention had costs. National debts exploded. Interest rates dropped to zero. Savers got crushed. People holding cash in safe accounts earned nothing for over a decade while asset prices inflated. So the money wasn't destroyed. It was redistributed. From depositors to borrowers. From savers to speculators. From the cautious to the leveraged. And this is the part people miss. When the banking system is rescued, it's not free. Someone pays. Usually, it's the people who were trying to be responsible. The ones who saved. Who avoided debt. who kept cash in the bank because that's what you're supposed to do. They don't lose everything. They just lose slowly, through inflation, through zero returns, through policies designed to restart lending at the expense of saving. The control mechanism. Here's how control actually works in a banking crisis. It's not loud. It's not obvious. It's procedural. A bank starts struggling. Regulators step in quietly. They don't announce trouble. They arrange a merger, or they inject capital, or they guarantee certain liabilities. All of this happens behind closed doors. Depositors find out later. Maybe their bank has a new name. Maybe their interest rate dropped. Maybe their account terms changed. But by the time they know, the decisions have been made. And those decisions were not about protecting deposits. They were about preventing panic. Because panic is the real enemy. Not bad loans. Not poor management. Panic. If people believe their money is safe, the system holds. If they don't, it collapses. So the entire structure of banking regulation is designed to manage belief. Confidence is the product. Deposits are the raw material. And your sense of security is the marketing. This is why bank failures are announced on Friday evenings, why mergers happen over weekends, why press releases emphasize continuity and stability. It's not transparency. It's crisis communication. The goal is to stop you from withdrawing your money before the system stabilizes. And it usually works. Most people don't move their deposits. They trust the system will sort itself out. And most of the time, it does. But that trust is not based on safety. It's based on the fact that the last crisis got managed, which is not the same thing as protection. What this means for you. So what does all this mean practically? It means your money in the bank is not actually yours in the way you think. It's a liability on the bank's balance sheet, a promise to pay. And promises are only as good as the institution making them and the government backing them. It means deposit insurance is real but limited. If your bank fails and you're under the limit, you'll probably be fine. If you're over, you might not be. And if the whole system fails, insurance becomes a political question, not a legal guarantee. It means the safety of your money depends on forces you don't control. Central bank policy, regulatory decisions, market confidence, legislative choices. You can be perfectly responsible and still lose because the system around you breaks. And it means the people who understand this position themselves differently. They diversify, not just across banks, but across asset types. They hold some cash, some gold, some property, some investments, not because they're paranoid, but because they know a single point of failure is a risk. Most people never think about this until it's too late, until their bank is closed, until their account is frozen, until they're reading news articles about bail-ins and wondering how this could happen in a modern economy. But it's not a surprise. It's the design, the final truth. So who controls money when banks are in trouble? Not you. Not really. You control the decision to deposit. You control the decision to withdraw until you don't. And the moment you can't access your money because the bank is closed or the system is frozen, control belongs to someone else. That someone is a network of institutions making decisions about systemic stability. And you are a data point in that calculation. Not a priority, not a client. A number. If saving you helps the system, you get saved. If not, you get restructured, bailed in, converted, delayed, or told to wait while smarter money moves first. This isn't a conspiracy. It's not corruption. It's just how the system is built. Banks profit by lending your deposits. Regulators protect the system, not individuals. Central banks manage aggregate outcomes, not personal wealth. And markets reward those who move fast, not those who trust slowly. The uncomfortable truth is that money in a bank is not safe because it's protected. It's safe because failure is rare and rescues are common. But rare is not never, and common is not guaranteed. And the moment the system is tested beyond its capacity, the rules change. Which leaves you with a choice. You can trust the system because it's worked before. You can prepare for the system to fail because it has before. Or you can do what people who understand this deeply do. Assume the system is resilient, but not unbreakable, and position accordingly. Because the people who control money when banks collapse are the ones who saw it coming, the ones who moved early, the ones who didn't wait for permission or reassurance or official announcements. And the rest are left reading articles about how their deposits became claims, how their safety became a negotiation, how their money became someone else's decision. That's the system. And it's not changing. So the question isn't whether you can trust banks. It's whether you understand what trust actually means when your money becomes their leverage. And once you do, you stop asking who controls money. You start asking how much control you're willing to give up for the convenience of believing someone else will protect it. Because they won't, not you specifically. They'll protect the system. And if you're lucky, you'll be inside it when it gets saved. If not, you'll learn exactly where you stood in line. And by then, control will have already shifted. Quietly. Mechanically. Almost politely. Just like it always does. If this changed how you think about where your money actually is, subscribe. Because next week, we're breaking down what happens when currencies collapse. Not if, when. And who profits while everyone else scrambles. Hit that notification bell. These topics don't stay comfortable for long.